Now, the part of the show where I like to highlight three things that I think individual investors should be focused on before you make your investment decisions. And as we've said off the top of the show, Fed rate decision day, the day has finally arrived where we get to hear what the Federal Reserve wants to do with respect to interest rates. Will they cut a quarter point? Will they cut half a point? How long can the markets keep hitting new highs? Well, we all know that when markets hit new highs, usually they can maintain those highs only for a certain amount of time. And at some point, the market will sell off. So, how long can they keep these highs going? And lastly, or our third idea, what could upset the markets? Again, another thing that individual investors need to keep in mind. What could pop up, or what could happen, or what's going to happen that could derail the markets and cause the markets to pull back. So let's start with the Fed rate decision. And I think a good chart to start with is actually the US Consumer Price Index chart, where we show the difference once again between where inflation is versus the Fed funds rate. And you can see inflation, like it was in Canada not too long ago, sitting at around 2.5%. And you look at the Fed funds rate, you're looking at a Fed funds rate above 5%. You're looking at here the, I guess, the less food and energy, or the core inflation rate at 3.2%. And so, again, coming down, but still not at where the Fed would like it to be. If you look at the next chart that we have, which shows PCE, once again, you're showing a 2.5% inflation rate. There it is. And pretty much most of the measures that the Fed uses to look at PCE, whether it's core, whether it's headline, you're coming in roughly at 2.5%. If we then move forward to a chart that's going to show, here it is, the difference between the Fed funds rate. So Fed funds rate and the 12-month changes, chart number 10 there, we can pull that up. You'll see that it goes 5.25%, 5.5% versus 2.5%. There it is right there. And that shows the big gap, the gap between what the Fed can do and where things are sitting now. And again, like in Canada, well over double the inflation rate is where the Fed funds rate is sitting right now. If we show the US Fed target rate, chart number 9 there, we can see that the Fed fund, or the rates have gone up extremely high over the last few years. It's now pretty much flatlined for a little while now. And I think many people are saying it's now time. It's now time to make a move. It's time for the Fed to make a move. And the question is whether they go 25 basis points or 50 basis points. And there is a lot of confusion behind that. So on one hand, you have an inflation rate coming down to 2.5%. You have let's take a look at unemployment. Let's take a look at jobs growth, jobs creation, monthly job creation in the US. You can see numbers coming down there. There you have it. We've seen a number of revisions in the jobs report. And not surprising, last month we were over 100,000 jobs created, and ended up being only 89,000 jobs created. Jobs for the month of, sorry, that was for the month of July. For the month of August, last month, we have a number of about 142,000 jobs created. And if the trend continues, we'll probably see a revision down to that as well. So jobs are coming down along with the inflation rate. Job openings are coming down. We are definitely seeing a slowdown in the economy and in the market. So that would call for the Fed to perhaps take more of an aggressive tone, maybe cut 50 basis points. But then you look at other data, like, for example, retail sales. US retail sales have been pretty strong. There's the monthly change in US retail sales. Last month, it was actually revised, but revised upward. It actually was more or greater than a 1% retail sales number, which you don't see often. You can see that it hasn't been over 1% in quite some time. This past month, so in August, July was revised above 1%. In August, you're looking at slightly above what they were expecting as well for retail sales. You also look at GDP. If we can pull up our GDP charts here, there you go. You can see that at our last revised look at second quarter GDP, it was 3%. 3% growth rate for the United States is great. And from what I've been hearing, the third quarter is kind of trending around 3% as well. So if you look at retail sales and growth numbers like GDP, you would say, why would the Fed need to cut rates aggressively? But then you look at the unemployment rate going up, you look at jobs creation and jobs growth kind of getting slower, and you might say, well, maybe 50 basis points makes sense. So overall, to me, whether it's a quarter point or 50 basis points, I don't think it matters. What I do think matters most is that we are going now in an interest rate cutting direction, and that's important for the market and certain investments within our portfolios. Second point I wanted to make with regards to before you make your investment decisions, you should think about, can the markets continue to move higher? Can we continue to reach all-time highs? And our first chart here we have of the S&P 500 showing at an all-time high, which I think most of you know, the markets are at pretty much all-time highs. So what can keep markets making all-time highs? Well, the first point I wanted to make is consider what is happening now. The Federal Reserve, Bank of Canada are starting to cut interest rates. Now, normally we cut interest rates or we see interest rate cuts, and the market's usually having difficulties. It's struggling. Economy is struggling. The market is struggling. The Bank of Canada, the Federal Reserve, needs to cut rates to become more stimulative so that economy can get better. And obviously, if the economy gets better, stock market will follow. Well, right now, we're actually going to see cuts by the Fed today, by the Bank of Canada already, while the market is at all-time highs. So one would think, well, if we're cutting with the market at all-time highs, yes, it is possible that we can make new highs if we get more stimulative interest rate policy by the central banks. What's to prevent the market from going higher? You start cutting rates, good for the economy, good for interest-sensitive areas like technology and many other parts of the economy. We know tech makes up 50% of the S&P. And yes, I think you could see this market continue to go higher based on this idea that central banks are now cutting rates, even though we are at all-time highs. A second reason why I think this market can make new highs is this idea about PE ratios. And we have a chart here, S&P 500 PE ratios. And a lot of people will say, well, the PE ratio for the S&P is pretty high. And it is. But if you strip out the Magnificent Seven, if you can go back to the chart we just had, if you strip out the Magnificent Seven, right there, yes, thank you, you would see that it's actually not that expensive at all. You're probably trading around 18 times earnings. So yes, the Magnificent Seven, seven largest companies, biggest tech names, biggest companies in the world, they have that much of an influence on the overall stock market. So they make us feel that the market is expensive and therefore should be sold, when in fact, 493 stocks are trading at reasonable valuations, 18 times, 17 times. So the market is not expensive if you factor out some of these big cap tech names. So these are two reasons why I believe, yes, the stock market can continue to make new highs, even though, you know, we may think, well, how high can it go? What goes up must come down. I hear that all the time. No, in this case, I think we will see the market higher by the end of this year than it is today. Our third point that I wanted to convey today for individual investors to consider when you make your investment decision is what could hurt the markets at this point. And, you know, in life, it's funny. It depends on how you look at things, right? I tell you that the market is actually not that expensive if you factor out the Mag 7. Well, our first chart, we actually showed it briefly a moment ago, our chart on the S&P 500. Now, this would be the total S&P 500. And you could see that if you factor in all stocks, yes, the S&P 500 is expensive when you look at it from an historical standpoint. So yes, valuations getting stretched, that could bring down the overall markets. And it's something that I think individual investors need to focus on. Valuations, markets getting too stretched. A second point that could bring down the markets possibly is the upcoming election. And we hear a lot about the upcoming election, what it can do, what is being promised by the candidates, cutting taxes, raising taxes, etc. And it's something that I know investors are paying attention to. Our next chart here, S&P 500 rally, is backed by rising earnings. There you have it. We've seen earnings rise. We've seen the stock market rise right along step or right with it. But you can see there, corporate tax policy reform could shift U.S. earnings per share trend. So raising taxes, if the United States were to start raising taxes, corporate tax, individual taxes, it could change the dynamic. It could cause the stock market to start to pull back. It could start to get nervous. And depending on what taxes you raise, corporate, individual, start putting taxes on unrealized gains for individuals. These are all things that I believe could hurt the market and cause the market to sputter, to perhaps pull back a little bit if whoever's in the White House were to raise taxes. And for that matter, I know former President Trump talks about putting on or increasing tariffs. Many people believe that a tariff is just like another tax. So we'll have to see who, I guess, wins the race for the White House, who is in the White House come November. I guess they don't take office until the new year, but who's elected in November and what their tax policies are, tariff policies are. And that could go a long way as to what happens with the stock market. We have another chart here. S&P 500 has posted gains during the calendar year where, we see a cut in taxes. And that's not always the case. Sometimes we see a cut in taxes and the market moves higher. Sometimes we see an increase in taxes, which is the dark line or the dark bars, and we still see the stock market move up. So we can see taxes rise and the stock market rise. And sometimes we see taxes being cut and then the stock market rises. So it's mixed. There's a mixed feeling. And I think that's why there's so much uncertainty with respect to tax policy and with respect to, what's going on, what's going to happen come November. And again, to me, that is something we need to watch for. And lastly, with regards to what could derail or bring down markets, if the Fed decides not to go along with the game plan of the stock market, right? Stock market thinks that the Fed is going to cut rates 25, 50 basis points, maybe cut as much as 100 basis points or 1 full percentage point by the end of the year. But what if the Fed doesn't go along with that? What if they only cut 50 or 75 basis points? Will the market react positively? Probably not. I think the market is getting ahead of the Fed. I think investors are trying to guess what's going to happen, and they're trying to make their investments prior to that. So if the Federal Reserve doesn't go along with what the stock market anticipates, this too could cause the markets to fall. So if you're an individual investor today, I think what you want to look at, as I said, you want to look at the Fed rate decision at 2 p.m. today and what they say going forward. I think you want to look at, indications or ideas on if this market can continue to maintain its current path. Can it continue to make new highs? And lastly, what can derail these markets? And I think if you look at those three things, more macro in nature today, the points I'm making today, I think that would be important before you make your investment decisions.